Okay, so let's start. We want to continue from where we left. We want to start a new topic, so let me introduce it. Now, we want to start this topic called published accounts. That's the topic we want to do. So let me introduce it. Whenever you're a public company, you are required to prepare what we call published accounts. For every public company, they are required to prepare what we call published accounts for publication purposes. Because if you're a public company, your accounts should be available to the public. So when you are preparing a complete set of financial statements as a company, what should you include? In that complete set of financial statement? And that's what we want to talk about now. So what are the components? We normally call them components. Don't write. Components of a complete set of financial statements. Every complete set of financial statements for publication purposes should include 5 components. One is the statement. As a company, in your complete set of financial statement, you should include a statement of financial position. A statement of financial position. This is what you could also call a balance sheet. That's one component of a complete set of financial statement. Number 2 is what we call statement of profit or loss. Statement of profit or loss and other comprehensive incomes. Statement of profit or loss and other comprehensive incomes. We shall look at how to prepare it in a short while. But that's another component that as a company you should include in your complete set of financial statements. Number 3, another component of a complete set of financial statement is what we call a statement. As a company, you should include what we call statement of changes in equity. You should include a statement of changes in equity. We shall look at what it is and how to prepare it. Another component that you as a company should include in your complete set of financial statement is what we call a statement of cash flows. The statement of cash flows. The cash flows you used to prepare in financial accounting, that's the same cash flow you should include in a complete set of financial statement. Number 5, another component you should include is what we call accounting policies. Accounting policies. You should tell the readers of your financial statements what are the accounting policies that you as a company you have used. Accounting policies and what we call explanatory notes. Accounting policy and explanatory notes. That is it. So these are components of a complete set of financial statements. It's good to know them because once in a while your examiner will ask you, or normally ask you, a theory question. State the components of a complete set of financial statement. And so we are saying there are those 5 components. One is the statement of financial position, or what you could call the balance sheet. Number 2, statement of profit or loss and other comprehensive incomes. Number 3, statement of changes in equity. Number 4, statement of cash flows. And number 5, accounting policies and explanatory notes. Good. So before we continue and discuss how to prepare each of them, you are in this group. If you are in this group and maybe you have not subscribed, if you are in this group and you have not subscribed to my YouTube channel, please subscribe to my YouTube channel. Just click on that subscription button down there to join the subscribers so that you will be notified whenever we post videos to the YouTube. So please subscribe if you are watching this video and you have not subscribed to my YouTube channel, please just go back, click the subscription button down there. You can do it even as you are watching this video. So please subscribe if you have not subscribed to my YouTube channel. So let's continue now. So as you're watching, if you have not subscribed, please subscribe to my YouTube channel. Okay, so let's now go on. So we want to look at now, how do you prepare for purpose of publication? How do you prepare these components for purpose of publication? Listen, there is a difference between how you prepare them for internal reporting. When you are preparing a balance sheet, for example, for purpose of internal reporting of the company, there is a difference between how you prepare it and how you prepare it for publication purposes. How you prepare an income statement, or what we are calling a statement of profit and loss. There is a difference between how you used to prepare it in financial accounting for internal reporting of your business and how you prepare it for purpose of publication in published accounts. So we want to look at the rules of how to prepare each of them, so that when you are given a question on this topic, you know how to do it. But before we look at how to prepare each of them, let's put down something on what we have already said. Let's put down something on what we have already said. So the topic is published accounts. So put down the topic. The topic is published accounts. The topic is published accounts. So put down. The topic is published accounts. Then you say this. Then you say this. The following are the components. The following are the components of a complete set of financial statements. The following are the components of a complete set of financial statements for publication purposes. The following are the components of a complete set of financial statements for publication purposes. Number one, statement of financial position. Statement of financial position. Number two, statement of profit or loss. Statement of profit or loss and other comprehensive incomes. Statement of profit or loss and other comprehensive incomes. Number three, statement of changes in equity. Statement of changes in equity. Statement of changes in equity. Number four, statement of cash flows. Statement of cash flows. And number five, accounting policies and explanatory notes. Accounting policies and explanatory notes. Accounting policies and explanatory notes. Good. Let me now discuss each of them and how to use it, or how to prepare it for publication purposes. So let me start with the first one, and I want to start, listen, I want to start with the statement of profit or loss and other comprehensive incomes. How to prepare the statement of profit or loss and other comprehensive incomes. So let me start with the statement of profit or loss. Statement of profit or loss. Okay. Now, listen. Listen carefully. Before I discuss how to prepare it for purpose of publication, let me remind you a few things on how you used to prepare this for purpose of internal reporting. In other words, how are you preparing it for internal reporting? You remember, you used to start with the figure for sales. Whatever the figure the examiner gives you for sales, You had to pick it. Okay. Then you used to come to cost of sales. Listen carefully now. Listen carefully here. When it came to cost of sales, when you are doing this in financial accounting, you remember you had to determine the figure for cost of sales by taking opening stock, add purchases, and less closing stock. You remember that? So what you used to do, you used to come and show opening stock there. You had to come and say purchases, get what you were calling the goods available for sale, if you remember. Then you had to get the closing stock, you minus. Then you had to get the cost of sales. You had to push it to the extreme so that you had to get what you were calling the gross profit. That's what you used to do for purpose of internal reporting. Get the point? For purpose of internal reporting. Now, there is one key difference now that I want to bring in now. Whenever you are required to prepare this statement of profit or loss for publication purposes, listen to this now, for publication purposes, then one of the rules is this, that you are not required, listen, you are not required to show the workings of the cost of sales on the face of the income statement. You do not show the workings of the cost of sales on the face of the income statement like I've shown you before. No. Listen, what you are required to do is to go and do that calculation somewhere. Get the figure for cost of sales somewhere as a working somewhere and bring it as a single amount. Bring it as a single amount. That's one key important difference. As we shall be proceeding, we shall be identifying others. But one key important point you should remember now is that you don't show the cost of sales calculation on the face of the income statement. You do that calculation somewhere, bring it as a single amount. The calculation does not change. Take the opening stock, add purchases, less closing stock, and whatever else that you are required to charge to cost of sales. Whatever it is, do that working somewhere, bring it as a single amount. Are you there? Good. Once you get it, now you get the gross profit. Okay, now listen again. You also remember for internal reporting, once you got the figure for gross profit, you had to minus expenses. You had to minus expenses. Electricity, water, telephone, insurance, and so on. Get the point now? But listen, when it comes to an income statement for publication purposes, listen, for publication purposes, you are not required to show the individual expenses on the face of the income statement. Don't come and tell us electricity, water, salaries, insurance, and so on. No, listen. You are required to classify. It's true you are to minus expenses. There is no question about it. You are to minus expenses. But these expenses should be classified according to their function. According to the function they perform in an organization. There are two classes of functions that can be performed in an organization. One of them is an expense can be said to be of administration in nature. So if your expense is one of administration in nature, then you classify all of them, all the expenses that you as a company you think are of administration in nature, combine them again somewhere, and bring it as a single amount. So you may come and say your admin expenses or administration expenses. You don't show them individually again on the face of the income statement, no. But instead, combine them somewhere, bring them as a single amount on the face of the P&L account as a single amount. The other function that may be performed in an organization, another function that may be performed in an organization is what we call selling and distribution function. So any expense that you as a company could have incurred, which you think that expense should be falling under selling and selling and distribution. For example, when you have advertising, that's an example of a selling and distribution expense. It's incurred in the process of selling and distributing. When you have salaries to the salesmen, that's another example of a selling and distribution expense. When you have expense like depreciation of delivery van, that's an example of a selling and distribution expense. So we are saying classify all your expenses according to their function. If you think it's of administration in nature, put it as an administration expense. Like obvious electricity of the office, we use office for administration. If you are paying salary to the office workers, they are involved in administration. Salary to the general manager, the general manager, he's just a general manager, that's administration, and so on. So you classify the expenses according to their function. Again, get the total of that function as one figure, bring it there. The second function we have said is selling and distribution. Let me just call it distribution expenses. Let me just call it distribution expenses. That's the second class of expenses. Good. Now, once you're through with the expenses, you minus them from the gross profit. What you normally get there is what we call profit from operations. You get what we call profit from operations. Okay, good. Once you get that profit from operations, we normally come and minus what we call finance cost. Finance cost. Of course, I want to believe that by now, all of you should give me one example of a finance cost. All of you should be able to give me an example of a finance cost. It's obvious. One example of a finance cost is what we call interest. Is what we call interest. Okay? Whether interest on loan or interest on debenture, you have borrowed. When you borrow, that cost of borrowing or that cost of financing your business is what we call the finance cost. When you borrowed through loans, you have interest on loan. When you borrowed through issue of debentures, you have interest on debenture. That's one of them. That's what we are calling interest expense. I've given you one example. I am not saying that that is the only example of a finance cost. No. There are other examples of finance cost. Maybe we can discuss them later as we develop the topic. But for now, let me assume that that is the only one. Once you get it, you minus whatever it is. Again, listen. Interest. Yeah. Thank you. You have given me interest. That's one. Do you know another one? Maybe I should ask you. Quenta. Is it Quenta or who? Do you know another one? Do you know another example of a finance cost? Now that you have given me one. Yeah, you chat and give me another one if you know another one. Quenta. Adhiambo. Do you know another example of a finance cost? Maybe you know of another one. I didn't ask you, but you gave me that one, which is correct. Do you know of another one? Yes or no? I'm waiting for Adhiambo to tell me yes or no. Bank charges, that's still under whatever. That's still under interest. Redeemable preference. Caroline, there's something missing. Caroline. There is something missing there, Caroline. Good. But I will explain. Let me leave it for now. I will explain that in detail. Caroline, you have some idea, but there is something missing in your point. But we shall discuss. Good. Okay, let's move on. Interest. There is nothing like interest There is nothing like interest on redeemable. I'll discuss it. Caroline, I'll discuss it. I'll discuss it in a short while. Thank you otherwise. Thank you. Now, assuming you have identified the finance cost, you now come to the next item, and that next item is what we call investment income. Investment income. As a company, you may have some investments, and those investments are earning you an income. That income could be in form of dividend. Maybe you have invested in terms of shares, and those shares are giving you dividend, so you have a dividend income. Alternatively, you could have bought things like treasury bills, treasury bonds, and they are earning you an income in terms of interest. So we are saying investment income need not only be in form of dividend, it can also be in form of interest income, whatever it might be. Okay, that is what we are saying you earn if there is any investment income. Once you do that, you get what we call profit before tax. You get what we call profit before tax. From there, you come to the next item, which is normally tax. Now listen, when it comes to tax, we may have different form of taxes. One is what we call the normal corporation tax, or what you can call current tax, whatever the figure the examiner will give you. The other form of tax is what we could call deferred tax. Deferred tax. Now listen, when it comes to deferred tax, you either add that amount to the amount of the current tax, or there are times you minus the amount of deferred tax from the current tax. Whichever the case might be, we shall discuss in details. This deferred tax, when do we add it to the current tax amount? When do we deduct it from the current tax amount? But whichever the way, get the net of those two, and that net is what you push to the extreme, and that's what becomes the tax expense for that year. Okay, good. Once you get the tax expense and you minus from the profit before tax, you get what we call profit after tax. You get what we call profit after tax. Good. Now listen, this is what you also used to do in financial accounting of the foundation level, or for those who did the previous curriculum, we used to call it section 1, financial accounting of section 1. Good. But listen, you remember, once you got the profit after tax, you had to appropriate this profit with the appropriations that are made by a normal company. You had to appropriate. You remember, you used to have appropriations in form of dividends, whatever it is. Maybe there is dividends being paid during the year, dividends paid. Maybe there was something like transfers to general reserve. Maybe out of your profit after tax, as a company could have decided to transfer some amount to the general reserve. Whatever it is, you had to minus. Then you remember, once you minus the appropriations from the profit after tax, listen, you used to get what we called retained profit for the year. You used to get what we call retained profit for the year. Okay. Once you got that profit after tax for retained profit for the year, you remember you used to come and add what is called a retained profit brought down. Retained profit brought down. Okay. Whatever it is. Then you remember you used to get what you call the retained profit carried down. Now listen to another key important point. Now listen to another key important point. Now listen. When it comes to publication purposes, or for publication purposes, we do not, listen to this now, we do not do the appropriations of this profit. We don't do the appropriations of the profit in the income statement like I've done. It's true the appropriations are done out of the profit. So it's also true when you are doing P&L account or income statement for publication or for internal reporting, you have to appropriate. But now for publication purposes, when you are preparing this income statement or when you are preparing this statement of profit or loss for publication purposes, listen, you don't show these appropriations, you don't show these appropriations in the statement of profit or loss. No. All these appropriations are done elsewhere. And that elsewhere is what we call the statement of changes in equity. So all these appropriations should not be shown in the income statement. We shall be showing them elsewhere, and that is where we are calling it statement of changes in equity. Listen. So up to this point now, we are through. Once you get the profit after tax, that's what I want to say. Once you get the profit after tax, then you are through with what we call the statement of profit or loss, or what you could call an income statement. Listen. But if the question tells you, prepare a statement of profit or loss and other comprehensive incomes, or a question tells you, prepare an income statement or a statement of comprehensive income, then listen, once you get this profit after tax, you don't stop here now. You now come and show what we are calling other comprehensive incomes. You are now required to identify other comprehensive incomes. You have to list them, whatever they are. Listen, once you identify the other comprehensive incomes of the company, then you get the total, and that total is what we call the total comprehensive incomes, Now, what are these comprehensive incomes? These are gains that you as a company you could have made. As a company you made a gain, listen, but the rules of accounting do not allow you to take those gains to the profit or loss. Yet as a company you have made a gain. But that gain, according to the rules of accounting, should not go to the profit or loss. So when you have such gains, then we are saying show them as part of other comprehensive incomes. Let me give you an example. If you have an asset like land, which maybe has a book value of 100 million by the beginning of the year, and during the year, you as a company, you decided to revalue this land, and you revalued it upwards by an extra 20 million. It's obvious the double entry would be you will debit land by 20 million and you normally credit an account called revaluation reserve. That's the double entry. You debit the asset, you credit revaluation reserve. This 20, is it a gain to the company? Yes. Should it not go to the profit and loss? No. It goes direct to a reserve account. Though it's a gain, the rules of accounting don't say I take it to the P&L. The rules don't say that I debit machinery or I debit land and I credit P&L account. As much as true, that 20 is a gain. I don't take it to the profit and loss. No. I take it to a reserve. But is it a gain? Yes. So those are kind of examples of gains that you as a company you could have made, but the rules of accounting don't allow you to take those gains to the profit or loss. So one example of other comprehensive income is what we could call gain on revaluation. Gain on revaluation of fixed assets. Gain on revaluation of fixed assets like machinery, motor vehicle, furniture, land, and buildings. Good. Of course, if it's a loss, you normally credit the asset, you debit revaluation reserve. If it's still a loss, you debit the reserve. It's a loss, but that loss does not go to the P&L account. So you minus if it's a loss. Good. Now listen. Another example could be whenever as a company you undertake foreign currency transactions. Whenever as a company you undertake what we call foreign currency transactions, then somewhere you will be required to translate one currency from Kenya shilling to another currency. In the process of translating one currency to another, there could be a chance that as a company you may gain or lose just because of the fluctuations in the exchange rate. Just because of the fluctuations in the exchange rate. Let me use a simple example, simple example. You bought something from US and you bought it on credit for $1. You bought it on credit for $1. When you are recording that purchase on credit, you will not record it in your books in dollars. You will record it in Kenya shillings. So, you will ask yourself, by the time I was buying these goods from US for $1, what was the exchange rate? Let us assume 1 Kenya shilling by that time was equivalent to 100 shillings. So you will debit your purchases and you will credit your creditors by 100. Are you there? That is still $1. Maybe you agreed you will pay by the end of the year. When the time of payment came, you will not pay that company in Kenya shillings. No, you will not pay them in Kenya shillings. You will pay them in dollar. So you will ask yourself, listen, for me to get $1 so that I pay the company in US, how many Kenya shillings do I need by the end of the year? Suppose to get $1, you need 95 Kenya shillings. You need 95. So what will you do? When the time of payment comes, you will debit your creditor because you are paying, and you will credit bank. You will not pay them $1. You will not pay them Kenya shillings. You will pay them in dollars. But by that time, how many Kenya shillings do you need for you to get that $1? You need 95 shillings. So you will debit creditors by 95 and you will credit bank. So you are still paying, though you are paying 95, you are still paying the dollar. You are still paying the dollar. The amount of liability has not changed. But if you look at this account, I was owing them 100 shillings by the beginning of the year. Now it's like I'm paying them 95. And I'm fully settling my debt. What does it mean? There's a difference of 5 shillings. Does it mean I still owe them 5 shillings? No, I've settled my debt. That 5 shillings is what we call the exchange difference on translation of the financial statement. And that to you now as a company is a gain. What if by the end of the year, $1 was equivalent to 105? So you will come and pay by the end of the year, and you want to pay $1. So you will ask yourself, how many Kenya shillings do I need to have for me to get the dollar? I need 105. So you will pay 105 in your books. So you will debit creditors by 105 and you will credit bank. It looks like you have overpaid because it's like you owed them 100 shillings. Now you are paying them 105. Are you overpaying? No. You are still paying the dollar. But when you look at this account, it's like you are overpaying. So that 5 shillings again is what we call the exchange difference on translation of the foreign currency transaction. This time, it's a loss. Don't forget, in all those cases, you are still paying the $1. So we are saying, whenever you have foreign currency transactions, there are types of exchange differences whose rules require that you don't take that gain or loss the P&L account. Not all of them. There are some gains or losses. If you are to go into the details of that topic of translation, then there are some gains or losses whose rules don't require you to take that gain of 5 shillings to the P&L account. No. But is it a gain? Yes. So another example of other comprehensive income could be what we call exchange difference. Exchange difference on translation. Exchange difference on translation of foreign currency transactions. Foreign currency transactions. Okay. For now, let me use those two as other examples of other comprehensive incomes. Good. Now listen. So in general now, you know the format of a statement of profit or loss, or what you could call an income statement for publication purposes. You have said, pick the sales, whatever the question will give you, calculate the cost of sales somewhere. I told you, calculate that figure called cost of sales somewhere and bring it as a single amount. We have mentioned that key important point, that you don't show the workings of the cost of sales on the face of the income statement. No. Instead, do that calculation somewhere, bring that single amount as the figure cost of sales. Get your normal GP. Then I've said you minus the expenses. I have said the expenses should be classified according to their function. Two categories of functions: the administration function and the selling and distribution function. For all your admin expenses, put them together, bring them as a single amount, and call it admin expenses. Then, for all your selling and distribution expenses, put them together again as a working somewhere, bring them as a single amount. Good. Then I've said, get what we call profit from operations, minus what we call finance cost. We have given one example. Second item is, what is the investment income? If your company had any investment income, whether in form of interest or dividend received, no problem. Get what we call profit before tax. Then you minus the tax expense. I've said, to get the tax expense, take whatever is the corporation tax for the year. That does not change. The question will give it to you. Then I've said adjust it. If the question has, adjust it with the amount we call deferred tax. I've told you, for deferred tax, there are times you add it to the corporation tax amount. There are times you deduct it from that amount of the corporation tax. How to deduct, when to deduct, and when to add, that is something we can discuss later. But let us assume we have done it. Get the tax expense, minus, then get what we call profit after tax. Another key important point I've mentioned here is, after getting profit after tax, we know we should do the appropriations of that profit. But we don't appropriate this profit in the income statement. No, I've told you that profit should be appropriated in the statement of changes in equity. Once you get the profit after tax, I've told you, it's like you are through with the income statement, or what you could call statement of profit or loss. Then I've told you, if the examiner tells you prepare a statement of profit or loss and other comprehensive incomes, then go through the question, identify what other comprehensive incomes you are given. Okay, we have given 2 examples. One is a gain or loss on revaluation of fixed assets. 2, we have said an exchange difference on translation of foreign currency transactions. Good. So before we discuss the second item, or before we discuss any other item, let's maybe put down what we have already said. Let's put down what we have already said. Have another paragraph, have another subheading, have another subheading, statement of profit or loss, statement of profit or loss, and other comprehensive incomes. Statement of profit or loss and other comprehensive incomes. A statement of profit or loss and other comprehensive incomes. Maybe we could put down the format. Let's put down now properly. So let's put down the format slowly. You just come and say your sales, whatever the question will give you. Okay. Then you come and say cost of sales, whatever it is, you minus, get what we call gross profit. Okay. Then we have said you come to admin expenses, put it down. Then you come to distribution expenses, whatever it is. Then I told you get the net, call it profit from operations, profit from operations, whatever you get. Okay. Once you do that, I told you you come to what we call finance cost. You can put in bracket interest expense. Interest expense. Maybe don't close the bracket because we shall discuss another one in a short while. But you show like you are minusing. Show like you are minusing. Then from there, I told you you come to what we have called investment income. Investment income. This I've told you could be in form of dividend received or interest income or interest received. You earned. Once you get that, I've told you get the net. That's what you call profit before tax. Profit before tax. Good. Let's move on. After getting profit before tax, we have agreed you come to tax. Tax we have agreed could be in form of current tax. I am putting that amount on the inner column. I'm putting that amount on the inner column. Then you come and adjust it with what we have called deferred tax. Either you add or you minus. We shall discuss that later. Either you add or you minus. We shall discuss that later. Then get the net. And that's what we are calling the tax expense. Once you get that, we have agreed you come and call this one profit after tax. So put it down. So I told you, once you are there, you are through with the income statement. You are through with the income statement. Now we want to go to the other comprehensive incomes. Good. Let's now come to other comprehensive incomes. Other comprehensive income. Other comprehensive income. We have said, we have given 2 examples. Let's quote them. Gain on revaluation. Gain on revaluation of fixed assets. 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 It could be a loss. If it's a loss you minus, then we have said there could be exchange difference. Exchange difference. That's the spelling, whatever the spelling. I think it's 1F. Exchange difference. Exchange difference on translation. Exchange difference on translation of foreign currency. Foreign currency transactions. Foreign currency transactions. Whatever that may be, get the totals. We have said that total is what you call total comprehensive. Total comprehensive incomes. Total comprehensive income. Good. Finish. I want to talk about 1 or 2 points among those items. I want to go back to the income statement and mention 1 key or 2 points concerning some of them. Finish. Okay, so I want to believe you are through. I want to believe you are through. We want to go back and discuss some of those items in details. I want to go back to the income statement and discuss some of those items in details. Okay, so let me go back. Done. Thank you. Somebody is already writing to us, Clara, that you are done. Thank you. Let's go back. Now, let me take you back now to finance cost. Finance cost. We have already said one example of a finance cost is interest. But listen, even the amount of interest that goes to the income statement is sometimes a challenge to get it. I want to take you back to your financial accounting and under the topic of company accounts. That's what I want to take you back. In that topic of company accounts, you used to be given a trial balance of a company, for example. And in that trial balance, don't write. In that trial balance, you used to be given something like this. You're given 10% debentures. Let us assume 500,000. In that trial balance, you're given something like interest on debentures, 40,000. My question to you is this. When you are given a trial balance of this nature, and the examiner told you required down there, prepare an income statement or prepare profit and loss. The question is this. How much were you charging in the P&L as interest? When you are given a question of this nature, how much were you charging as interest in the P&L account? I want somebody to chat and tell me, what do you charge? This is not something new. It is something you must have done in financial accounting. So I'm just asking you, because in any question of published accounts, there will always be debentures. Yes, somebody to chat. when you are given a trial balance of this nature and you are required to prepare an income statement, in that income statement, how much do you charge as interest in the P&L account? Somebody, I want you to chart and give me the amount. How much? When you are given a trial balance of this nature and you are told to prepare an income statement, from this trial balance or from this illustration, how much do you charge as interest in the P&L account? I'm waiting for somebody to chart. I'm waiting for somebody to chart and give me the amount. How much were you charging as interest in the income statement? Yes. 50. The Ambo says 50. Somebody else? Not saying she's wrong. Not saying she's right. 10,000. Caroline says 10,000. Somebody else? Caroline says 10,000. This is not something new. It is something you did in financial accounting. One more so that I discuss. One more so that I discuss. I want one more opinion. One more opinion. Another Caroline says 10,000. Now listen. Now listen. So that you know where you are right or wrong. Listen. You all know that whenever you are required to prepare an income statement, whenever you are required to prepare financial statements of any business, whether a sole trader, whether a partnership or a company, it does not matter. You remember, you used to follow, or you normally follow, what we call accrual concept. Whenever you are preparing financial statements, whether it's a sole trader or a company or a partnership, it doesn't matter. All financial statements should be prepared on accrual basis. In other words, that concept states that costs should be recognized when they are incurred, but not when money is paid. Costs are recognized when they are incurred, but not when money is paid. It also says revenue should be recognized when they are earned, but not when money is received. I hope you remember that concept, that costs are recognized when they are incurred, but not when money is paid. In other words, when you are preparing your financial statements, you should recognize the cost in the financial statements when the cost was incurred, but not when the money was paid. Recognize that cost when it was incurred in the income statement. Don't recognize it as a cost when it was paid. Recognize it in the income statement when it was incurred, but not in the year it was paid. For example, this company has a 10% debenture whose value is 500,000. It means what? It means that you as a company, every year you are required to pay your debenture holders an interest at 10%. 10% of 500,000 is 50,000. So listen, whether you have paid that 50 or not, when you are doing the income statement, it doesn't matter whether I've paid it or not. I should recognize the cost when it was incurred. This year, we incurred a cost of 50. Have we paid? I don't care. When I'm doing the income statement, I just come and recognize interest charge. How much? 50. When it was incurred. Listen, but when I'm doing the balance sheet for this company, That's the time I'm going to get concerned. Ask myself, as a company, do I owe my debenture holders anything? Do I owe them anything? According to this trial balance, I'm supposed to pay them 50, which is 10% of 500, but it looks like I've only paid them 40. So if I've only paid them 40 and I'm supposed to pay them 50, then it means I've not paid them another 10,000. That 10,000 which I've not paid to them, that's what I owe to them. So in the balance sheet of that year, I take that 10 as an owing in form of interest, owing of 10,000. So this is what you used to do. That whenever you are preparing an income statement and there was either a loan or a debenture, what you took to the income statement as interest charge, it is not what you have paid, but it is the charge for the year. When you came here, you are preparing this income statement, under finance cost now here, you had to show 50,000, not the 40. 40 is what you paid. But when you are preparing the income statement, you recognize costs when they are incurred, but not when money is paid. Good. Next. Suppose I am changing. Suppose in the trial balance, this is what you are given. I've changed. It's 2 now. When I look at this trial balance, I have 10% debentures, 500. In the same trial balance, I can't see interest. Question is this. When you are doing the income statement of this company, do you still charge interest? When you are preparing the income statement of this company, do you still charge interest? Yes. Whether you have paid it or not, so long as debentures are there, interest should be there. Every year, I'm supposed to pay my debenture holders their interest at 10%. 10% of 500 is 50. So when I'm doing this income statement, it doesn't matter whether I've paid or not. I'll still charge how much? 50. But when I'm going to prepare the balance sheet of this company now, that's when I get concerned. I ask myself, do I owe these debenture holders anything? So from this trial balance, I can see there is nothing like interest in the trial balance. So it means I've paid them nothing. So it means, therefore, the whole 50 charge for the year, is exactly what I owe to them again. I've not paid them. So by end of that year, in the balance sheet, you will still take a liability of how much? 50. So some of your questions in the past papers come as a case 1, where part of the interest was paid. And some of your questions come as case 2, where no interest is paid. So you must be careful whenever you are doing a question on published, whether we have debentures or loans, it doesn't matter. So long as debentures are there or loans are there, interest should be there. Interest should be there. But it is not what you have paid. It is the charge for the year. Good. So before we discuss another item, let's put down that summary information, because it is important even at this level, because I've told you, whenever a company or whenever you're tested on this topic of published, listen, and it's a very common topic in your syllabus. It's a very common topic in your syllabus. In the financial reporting, it's almost guaranteed to come. Almost guaranteed. Rarely will you miss it. In sittings, they follow each other. When I find in one sitting it was there, next sitting it was there, next sitting it was there, rarely would it miss. Okay? So it's a topic one should master. Topic one should master. Okay? Let's put down that a small item. So have another subtopic. Have another subtopic, treatment of debenture interest. 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 Okay. I want to put down the notes, but in terms of illustration. So for illustration 1, call it case 1. Call it case 1. Call it this way, where parts of the interest is paid. Where part of the interest is paid. Where part of the interest is paid. That's what we want to call case number 1. Then you show as if you are preparing a trial balance. Show as if you are preparing a trial balance. And in that trial balance, you show like there's a 10% debenture. Let's put it as 500,000. Okay. Then we come and say interest on debentures. Let's put it as 40. For purpose of illustration, show as if you are closing the trial balance. Show like you are closing the trial balance. Then after that, we have said show like you are preparing the income statement. You come and say your profit or loss. Profit and loss. How much will you charge? The P&L, we have said interest. It's 50. You think you'll forget, you can write there 10% of 500. Just to remind you how we are getting that 50. Whether you have paid it or not, that's what you have to take. You recognize the charge for the year. Whether you have paid it or not, what is the charge for that particular year? Good. Next, come and show like you are preparing the balance sheet now. I told you among the current liabilities now, you will have interest owing. Interest owing of 10. I'm supposed to pay them 50. I've only paid them 10 or 40. According to that trial balance, I've only paid them 40. So I owe them another 50. Sorry, I owe them 10. Good. So let's now go to case 2, assuming you're through with case 1. So finish copying. We now go to case 2. We now go to case 2 now. So finish, we go to case 2 now. I hope you are following up to this point. I hope you are following up to this point. So if you are through with case 1, then indica another subheading. Case 2. Indica another subheading, case 2. Where no interest. Where no interest is paid. Where no interest is paid, call it case 2. Then again, you show like you are preparing that trial balance. Call it 10% debentures. You credit column 500. And you show like you are closing the trial balance now. Show like you are closing the trial balance. Then you come and say P&L. What am I supposed to charge? We have already discussed. We have agreed whether you have paid interest or not. So long as debentures are there or loans are there. The question could be loan, question could be debenture, it's the same. Okay? So we are saying, again, you come and charge interest. How much? 50. Whether you have paid or not, that's not the concern of the income statement. No. Good. We go to the balance sheet now. We go to the balance sheet. Among the balance sheet items, we have current liabilities. Among the current liabilities, you have interest owing of how much? The same 50. We have not paid anything, so I owe them the same 50. Good. So that's all for interest as an example of a finance cost. As an example of a finance cost. Good. Finish. I want to develop the topic now. We want to touch on something else. Finish. Okay. So I hope you are through. I hope you are through now. So let me develop. Let me develop. Now, listen to this now. I'm going back now to Caroline. Caroline gave us something when I was asking other examples of finance cost. Caroline gave us something and I said not exactly. And so I want to discuss that area now. Listen. When a company wants to raise finances, one source of finance is for a company to issue preference shares. The company could issue what we call redeemable preference shares. Or maybe the company could issue what we call non-redeemable preference shares. Non-redeemable preference shares. Or let us assume these are two companies. One company decided to issue a 10% redeemable preference share worth 20 million. Another company issued a 10% non-redeemable preference share worth 20 million. So I want to take you back, because you should have done this. Listen, when you are required to prepare the balance sheet of these companies, this is company A, and this is company B. When you are required to prepare their balance sheets, will you take these two types of preference shares on the same part of the balance sheet? In other words, where you take the redeemable preference shares in the balance sheet, is it the same place you take the non-redeemable preference shares? The answer is no. The answer is no. But first, I hope you still know, or you still remember, what's the difference between a redeemable preference share and a non-redeemable preference share. I hope you still remember the difference. 10 years ago, when this company was issuing redeemable preference shares, they issued preference shares worth 20 million. Company B, 10 years ago, when they were raising finances, they issued a 10% non-redeemable preference shares. What's the difference between the two types of shares? Listen. For redeemable preference shares, when this company A was issuing it, it must have told the people who bought the shares that one time in the future, we shall redeem those shares. So company A has an obligation. When they were issuing the shares 10 years ago, they had an obligation to redeem. What is to redeem? To buy back the shares. Meaning that company A will be required one time in the future to pay back the 20 million. That's what is called redeeming. Company B, which issued 10 years ago non-redeemable preference shares, that company does not have an obligation to pay back the 20. So for company A, they have an obligation to pay back that 20 million, but company B has no obligation to pay back the 20 million. Now, because company A has an obligation to pay back the 20 million, listen, then they don't show their 20 million in the balance sheet under the section called financed by, that means under capital, no. Or what we call equity, no. Their 20 million, because they have an obligation to pay back, they will take it to the balance sheet as a long-term liability. In other words, where you normally take your 10% debenture in the balance sheet, that 500 we have been discussing, it is the same place where you now take your 10% redeemable preference shares. Why? Because you have an obligation to pay. Just like you have an obligation to pay back the debentures, you also have an obligation to pay back the redeemable preference shares. For the other company B, when they issued the 10% non-redeemable preference shares, they did not have an obligation to pay back. So they don't take their preference shares to the balance sheet as a liability. Instead, they take it to their balance sheet as a component of equity. That section where you normally show financed by, you come and say ordinary share capital, retained profit, share premium, general reserve, revaluation reserve in the balance sheet. That's where you also show the 10% non-redeemable preference shares. The 10% non-redeemable preference shares. So for balance sheet purposes, redeemable preference shares goes to the balance sheet as a long-term liability. The redeemable. That's important. Why? Because we have said you as a company that issued them, you have an obligation to pay back that 20 million. So, good. For the non-redeemable preference share, this company has no obligation to pay back. So for purpose of balance sheet, take it to the balance sheet as a component of equity. That's important. Now, both companies, now listen, both companies will be required by end of every year to pay their shareholders some dividends. Company A will pay how much? 10% of 20 million, they will pay dividends of 2 million. Company B will pay again their shareholders 10% of the 20 million, dividends 2 million again. Now listen carefully. So both companies are paying dividends on preference shares. But the question again, when it comes to the income statement, do you show the two dividends in the same place? Listen, the answer is no. Listen carefully now. When it comes to non-redeemable preference shares, non-redeemable, these 2 million they paid their shareholders as dividend, that should be considered as an appropriation of profit, as an appropriation of profit in the statement of changes in equity. Don't forget, I told you we don't do appropriations in the income statement. No, I told you we do the appropriations of a company in the statement of changes in equity. So these 2 million dividends paid to the non-redeemable preference shareholders, their dividend is considered as an appropriation of profit in the statement of changes in equity. For the dividend paid on the redeemable, for the dividends paid on redeemable preference shares, we consider them as an example of a finance cost. Why? Because you borrowed the 20 million. When you are issuing redeemable preference shares, you are borrowing because you will have to pay back. And because you borrowed, you will incur cost of borrowing, which is dividend of 2 million. So that will be considered as a finance cost. So the 20 million will now go to the income statement together with the finance cost of the 50. You remember? Good. Here in their income statement, now you will have preference dividends. So maybe what you could do now, go back to the format we have drawn, go down back to the format we have put down. Now where we had finance cost, you come and add now. I told you interest expense. Now you can say plus preference dividends, plus preference dividend. Then you close, then you minus. That's what I wanted to show as another, or what I wanted to say as another example of a finance cost. As another example of a finance cost. Now listen. Listen. Now, whenever the examiner gives you a question of published, once you find from the trial balance there are some preference shares, it is your responsibility now to find out which kind of preference shares are we dealing with. Are we dealing with the redeemable preference shares, or are we dealing with the non-redeemable preference shares? Why? Because their treatment is different. So some of your past papers come with questions where we have redeemable preference. Some questions come where we have non-redeemable preference. So the examiner would be keen to show or to see where you are taking the dividend of 2 million and where you are taking the capital or the amount of the 20 million in the balance sheet. We have already agreed, if it's non-redeemable, it's part of equity in the balance sheet. Each dividend is an appropriation of profit. If it's redeemable, and I've said, take it to the balance sheet as a long-term liability. Why? Because as a company, you have an obligation to pay back that amount. I've also said the dividend on redeemable preference shares, consider it as a finance cost in the income statement. Good. So I think I'm through now. With that introduction of how to prepare a statement of comprehensive income and other comprehensive incomes, a statement of profit or loss and other comprehensive incomes. Good. So today I just wanted to introduce that. Next time, what I'll do, listen, I'll give the summary notes on this subheading of preference dividends and preference shares. Maybe you can put down the summary, put down the subtopic, call it preference shares and treatment. No, just call it preference shares and preference dividends. Just call it preference shares and preference dividends. Put it down as a subtopic so that next time I'll start by giving the notes. Let me even write there, give notes. We shall put down the summary notes for that. Then we proceed. Okay? Talk about the other components. I told you there are rules for each of them. There are rules on how you should prepare it for publication purposes. And by the way, I hope, Caroline, you have seen now. You gave me something called interest on redeemable. Caroline, are you now okay? It's not called interest. It's called what? Dividend. Caroline, are you okay? It's not called interest. You gave me the term interest on redeemable. We are calling it dividend on redeemable. When I was asking that, Caroline, I hope you remember, you said interest on redeemable. But we are not calling it interest. We are calling it dividend on redeemable. Good. Now, for some of you, listen. For some of you, I just want to pass information so that you can pass this information to your friends who are likely to join the classes. Let me mention something concerning our course. Now, if you have friends who are interested in doing this financial reporting, tell them this, that we have financial reporting online classes every Tuesday, Thursday, and Friday from 8 p.m. to 10 p.m. Okay? If they cannot attend the live classes, then they can buy what we call pre-recorded videos, where they get the videos for the whole syllabus and they watch the videos at their own free time. Okay? Good. That's the program for financial reporting, the one we are doing. Is there in Tuesdays, Thursdays, and Friday. Now, we also have some of you who are friends who are doing advanced financial reporting. We also have some friends who are doing advanced financial reporting. Tell them they are willing to join. We have early morning classes and we have evening classes. Okay? Our early morning classes for advanced financial reporting are every Monday, Wednesday, and Friday. Monday, Wednesday, and Friday from 5:30 in the morning to 7 a.m. in the morning. For evening classes, we have them every Monday, Wednesday, and Saturday from 8 p.m. to 10 p.m. Again, if somebody among your friends cannot attend a live class, either early morning or evening, again, they can buy what we call pre-recorded videos, where they get the videos for the whole syllabus and watch them. Okay? Now, for any of them, we are charging 4,200. Whether you join a live class or you buy the pre-recorded videos, we are charging 4,200. We also accept payments on installments. We accept payments on installments, no problem. You can call. If you are interested in any one of this, then somebody can call me on this number, 0722 658875. 0722 65 8875. Good. Listen again. Some of you again have friends who are doing financial accounting or foundation level or ATD level 1 or level 2. There are those who are doing financial accounting of CFA and CS. Tell them that we are also teaching financial accounting. Tell them that we are also teaching financial accounting. Good. Either of the foundation level CPA or ATD level 1 or the financial accounting of ATD level 2. Those who are doing CFA, at the beginners level, there is financial accounting. For CS, at the beginners level, there is also financial accounting. So we have agreed. If they're interested, somebody can call me on that number, 0722 65 8875, whether for live classes or for pre-recorded videos. For everyone, even you now, we have agreed. Please subscribe to my YouTube channel by clicking that subscription button down there. You can also click the notification bell so that you are notified every time we post new videos to the YouTube. You will be notified. Okay? Good. Otherwise, I hope you have enjoyed the class. If you have enjoyed the class, you can also like the class by clicking that like button. You can also click it if you have enjoyed the class, and I hope you have enjoyed. So for our normal students, we continue next time, hoping others will join us in the next lesson. Otherwise, see you next time. Bye for now. Hope you have understood. Oh, Caroline has even answered and said yes. Now you're okay. That is called dividend. Good. Bye for now. I also want to believe, listen, I'm also asking now. I hope the sound was loud and clear. You chat and tell me yes. Was the sound loud and clear? I hope the sound was loud and clear. You chat and say yes, I want to know. Okay, fine. So see you next time. Yes. Enjoyed the lesson. Thank you that you have enjoyed the lesson. So click that like button. Who is that? Kelly? Robert. Click that like button that you have enjoyed the class. Thank you. Sawa. So see you next time. You tell your friends who are doing financial reporting. When are our classes for the live? We have said Tuesday, Thursday, and Friday. For those who are doing advanced financial reporting, tell them we have either early morning or evening. And the timings we have said for the early mornings, 5:30 to 7, Monday, Wednesday, and Friday. For the evening, Monday, Wednesday, and Saturday, from 8 p.m. to 10 p.m. I've told you either finance or whether financial reporting or advanced financial reporting, if they can't attend the live class, they can buy the pre-recorded videos for the whole syllabus and watch them at their own free time. I've given you my number there, 0722 65 8875. We have also said financial accounting, either foundation, your friends who are doing foundation level, ATD level 1, ATD level 2, or CFA, or CS. Good. Thank you very much. Caroline is saying something. The class was awesome. Thank you. Explain points very well. Thank you very much. Welcome. Fine. Bye for now. See you next lesson. Bye for now.